Welcome everyone to our webinar today. We're going to get started in about 2 minutes. So go ahead and pour that third cup of coffee and we'll be with you in just a moment. Thank you. Okay, we're going to go ahead and get started today. Hi, everyone. It's good to see everyone back again for another one of our webinars. My name is Michael Ibrahim, and I am Program Manager within the Cultural Investment Portfolio Program here at the Mass Cultural Council. Our program's focus is grants and services for nonprofit cultural organizations, and we are excited to present today's webinar, Financial Planning, Part 1. This workshop is part of our Recover, Rebuild, and Renew efforts to help organizations come back from COVID-19. As you probably know by now, this spring we're offering 2 free webinars every week, every Tuesday and Thursday through the end of June to help you out in the areas of finance, management, leadership, marketing, fundraising, boards, you name it. Joining us today is Robert Kagan from the Nonprofit Finance Fund. We're going to start in just a moment, but a few ground rules before we get started today. If you want to say hi in the chat, just to give a little wave and say who you are and your organization, we would love to hear from you. This session has automatic captioning. Auto-generated captioning are provided on all Mass Cultural Council Zoom meetings and webinars. If you need additional assistance to ensure your participation in our digital platforms, please let us know whenever you register. If this is distracting for you, you can also hide this by clicking hide subtitles in the closed captioning options at the bottom of Zoom. We will have time for questions and answers throughout this entire presentation. We don't need to wait to the very end. We just ask that you please use the Q&A function in Zoom, not the chat. We'll leave the chat for some resources that my colleague Sarah is going to put into the chat. So if you want to ask your questions using Q&A, that'll just help Robert keep that organized. But don't wait to the very end to ask questions. We want to make sure that you're asking questions and getting answers throughout the presentation today. This session is being recorded, as you can tell. And so we're going to have that available on our YouTube channel. We have hundreds of videos on our YouTube channel now, including all the videos from this session. We'll probably get that up by tomorrow. So if you want to share this presentation out to other board members or staff members or stakeholders, feel free to do that as we go along. As I mentioned, my colleague Sarah Glidden is here, and she's going to be providing some resources in the chat box. She's already started that, including the presentation that Robert is going through today. So if you prefer to watch things live, we've got that. If you prefer to go in your own speed and look ahead, you've got that as well. This session is running for 1 hour, and that's going to include time for questions and answers. And with that, I'd love to turn it over to Robert.
Thank you so much, Michael, and good afternoon, everyone. I'm really, really excited to be here and speaking with you about nonprofit finance today. I'm not sure quite how many of you have been part of our series before in talking about nonprofit finance, so I will go a little bit into detail about kind of just who we are and what this whole series is about. But I'm really excited particularly to be doing this because NFF is a national organization, but I am based in the Boston area in Massachusetts. And so it's always really a treat to get to know organizations that are working in the area and doing really incredible things. So before we get into all of those details, we do want to just take a moment to acknowledge the land on which we reside, and acknowledge the pain that has been caused and the harm that has been done, in order for us now to be on this land. And so we take just a moment to think about the native tribes who traditionally and historically have inhabited these lands. And so if you have not done this before, I believe that it was just put in the chat. This website, nativeland.ca, is a really incredible resource for being able to take a look at what tribe resides on the land in which you currently reside. And so as I'm going through some of the intro pieces here, feel free to take a look at that website if you haven't before, and also to just share in the chat if you feel comfortable where you're coming from in terms of live the live stuff. And I'm seeing Tracy saying that it's not quite showing up in the chat yet, and so that should be showing up in just a moment. And I should also acknowledge that while I typically am in Massachusetts, I am actually away from home right now, but I am currently on Munsee Lenape land. So while all of that is coming into the chat, I do also want to mention just who NFF is and how I came to be here. So NFF is a national organization. We spend time in a couple of different areas. First of all, we started and still are today as a community development financial institution, a CDFI. And so it started in about 1980, really with the focus on giving capital access to nonprofits. So really thinking about sending loans to nonprofits, allowing nonprofits to access capital as they need to think about cash flow, to think about expanding, to things of those natures. As sort of an outgrowth of that, our work in providing capital, we started to offer advice as well. We took a lot of what we learned from underwriting loans to nonprofits, from working with nonprofits throughout the country to really start thinking about what are the best practices in nonprofit financial management, and how does that actually wind up connecting to the strategies of organizations. And so that's the part of the organization in which I sit, really thinking about how do we connect dollars with mission, and how do we think about going through our future and moving, keeping money in mind. The last thing that we do as part of our work is take everything that we learn, both through our underwriting and our loan work, and through our work directly working with nonprofits, and we share it on a large scale. So we do a lot of webinars and things like that like what we're doing today, but we also share resources on our website. We share recordings of past webinars. We share tools that you can use yourself for doing things like cash flow planning and budgeting and things like that. And we really hope that our website and other resources that we share with the field will be helpful for organizations that are thinking about their finances, as well as also offering some advocacy. So we work with a lot of funders to think about how we can help dollars flow more equitably through the system. All of these different things we do, we really hold within our core values, and we work to be a values-driven organizations. We are ourselves a nonprofit, and hold that at the center of everything we do. So today's session builds a little bit upon the previous sessions, but I will also note that you don't have to have attended the previous sessions in order to gain something today and to learn today. And so today what we're really here to talk about is financial performance, which is a word that may or may not make sense as we continue to go along, but the idea really is to understand today how money is coming into organizations, and how money is going out of organizations. And so we want to think about different types of revenue and expense, and how having access to those different types of revenue and spending that money on different types of expenses winds up affecting organizations. And we want to sort of take that past history, the past understanding of our organizations, and use it to then think about our own futures and to think about what the connection is between the way that our organizations have performed financially in the past, and what that means for our budgeting, for our planning. Um, Other questions might come up. And so I know that this platform doesn't allow us to necessarily speak to each other, but I really would encourage you to utilize both the question and answer component of Zoom, as well as the chat box, to feel free to jump in with any questions or comments as we go through all of the pieces. I will stop every once in a while to just see what's happening in the chat and the question boxes. But again, feel free to really include throughout, and I'll do my best to get to those between sections. So as we think about specifically what our learning goals are for today, which are very similar to what we expect, we want to learn how to read and interpret income and loss statements or profit and loss statements, thinking about what does that actually look like? What are we actually looking for when we look at an audit or an internal financial statement? We want to connect the dynamics in our income expense history to our future budgets. Again, taking our past and seeing what we could learn from a financial perspective to apply for our future. And we want to think about key budget terms for forecasting revenue expense, budgeting for restricted revenue, and budgeting for one-time or episodic revenues and expense. And I'll get into really what all of that means in just a few moments. But everything I'm going to talk about today, and honestly, everything that we'll wind up talking about next week when some of my colleagues talk about the balance sheet, really comes back to this diagram here. And so I'm going to take more than a few minutes to really examine what we're looking at, which seems a little bit simple, but is much, much more complicated when we think about how to actually make this happen. And so at NFF, we really come from the perspective that surpluses are necessary in order for organizations to thrive. And I'll go through this little circle to show exactly what we mean by that. And so I'm going to start over on the left-hand side here for where it says business model. And we ask the question, are you able to cover your costs? And essentially the idea of a business model, whether we're talking about a for-profit business or a nonprofit, is that we need to be able to bring in enough money in order to spend money on the things that we need to do. In terms of an official definition that we use in the nonprofit space, we think about how we make and spend money in service of our mission. So again, we're here talking about money today, and most people don't get into the nonprofit world to talk about money, but money has a real effect on our ability to complete our mission. And so everything that we talk about in terms of dollars today, it always comes back to how it then connects to our ability to do the things that are really important within our work. So again, that business model, thinking about how we make and spend money in service of our mission, we're thinking about not only are we able to cover our costs, but we want to have a little bit more than being able to cover our costs, what we'll call a surplus or a profit. And the reason that we want to make sure that our business model is constantly generating a surplus is that when we bring in more money than we spend, what it allows us to do is invest in ourselves, invest in our balance sheet. And what our balance sheet is essentially our savings. It's the money that we have in our bank account. It's what we own, what we owe, and our net worth between the two. So again, when we have a surplus, we're able to put some money away for the future to think about growing our assets in a way that it will allow us to continue as an organization. So again, the kind of quick question there is, do we have enough cash? Do we have enough cash to manage any timing differences between when we're paid for work and when we need to pay our staff or our rent and things like that? Do we have enough of a safety net and a cushion so that if something bad happens that we're not able to bring in revenue that we expect, that we can survive through that difficult moment, like so many organizations are dealing with right now and in the past year? And sometimes we're able to just use our surpluses to build that balance sheet, but sometimes we also need an outside one-time investment. So what I mean by that is sometimes if we're not able to save enough over time, we might need, a large grant, for example, that'll help us to build up our balance sheet, particularly if we're thinking about change. Sometimes organizations think about this in terms of a capital campaign, that they're going to go through one specific period of time where they're going to look to raise a significant amount of money that either is going to use to fulfill a one-time purchase, or that they're going to use to build up their savings for the future. And part of the reason that it's so important to have those assets available to us on our balance sheet is that we want to be able to reinvest in our business model. The world is constantly changing, as we all know far too well this year. And so we want to have access to resources that allow us to make changes to better serve our communities, first and foremost, but also to adapt our business model to new realities. So that if, for example, the way that we used to work is no longer bringing in enough revenue for us to have those consistent surpluses, that we have the resources to make a change, to think about a new way of running our business or an additional way of running our organization, so that over time we're able to generate those surpluses again. In an ideal world, then we're able to sort of go round and round and round this wheel. We know that oftentimes that's a lot harder than it is for me to sit here and say that. But that's always when we think of quote unquote financial health, that's our goal, is to help nonprofits get to a point where they're able to work through this wheel. So I'm going to pause there and just see if there are any questions that are starting to come in. And I have one observation, just an observation. I think this is misrepresenting if we describe balance sheet as savings. There are more that go into it. Absolutely, and thank you for that comment. It's not only savings, but savings are a really important piece of it. Balance sheet includes both the assets we have, those things that we own, as well as our liabilities, those things that we owe to others, and the difference between the two, what we would call like our net worth or our net assets. And so I really do appreciate that comment. And if there are no other questions, I'm going to go ahead and push us forward. And so when we think about where we look for the balance sheet, because again, we're going to stay mostly on the left side of that diagram today and really just talk about the business model. And then during the next session, some of my colleagues are going to talk a little bit more about the balance sheet. But when we're looking at the business model, what we're looking at is the income statement, also called the profit and loss statement. And this is on either an audit or internal financial documents, where we would look to see how our business model is doing. Again, are we bringing in enough revenue to cover our expenses, and then hopefully have a little bit of a surplus. And so there are three different parts to an income statement. Up at the top, we have revenue. And oftentimes we'll list the different sources of revenue. And here are some of them. We're going to get in a little bit later to some more specifics about the sources of revenue here. But as starting from a general perspective, when we're talking about revenue, we're asking these questions. We want to understand, where is the money coming from? Was the revenue stream reliable or at risk? Meaning, can we expect to continue to have the money coming in for us? And then this third question, which it looks like Kenneth is saying is a really big issue there, is thinking about seasonality. Do we have all of our revenue coming in during one part of the year, and then need to stretch that money to last us for the rest of the year? And how are we thinking about the timing of when money comes in? So thank you for contributing that, Kenneth. On the expense side, which we'll see right below the revenue, we're thinking about different sort of big buckets of areas that we're expending money. Again, the specific line items are going to look a little different for every organization, but generally we want to think about, how are we spending the money? Can we predict what those expenses are going to be, or are expenses suddenly coming in that we wouldn't expect or we didn't know about? And are we able to make changes if we need to? Are we able to either make difficult choices, or preferably to see when tough times might be coming, and then have options for how to make changes, both in terms of hopefully trying to bring in some additional revenue, or potentially also for thinking about cutting expenses. And then sort of what a lot of people call the bottom line is our surplus or deficit. Starting with, are we able to cover our costs at its basic level? And then hopefully going that step further to again, think about surpluses so that we can save for our future. And so if we think about in a perfect world, right, again, the goal for what our business model will look like, we have our little magic wand here, but this is really what we're looking for. Um, we're hoping for those annual surpluses, as I mentioned before, to think not only about short-term needs, but also about long-term needs. We want to make sure, again, that this all connects back to mission. It's not just about having, that positive number on the bottom line, but really thinking about, are we bringing in the resources that allow us to do the work that we want to do? And do we know that our work is being effective? Do we have the data to know that whatever we're doing for our community is succeeding in fulfilling our mission? Um, do we have the right capacity and skills? Are staff fairly paid and supported in their jobs? Are staff and board feeling tired and panicked? This is, you can theoretically do the work oftentimes with less money than you really need. But in order to say that the business model works, we not only want to look at that bottom line, but want to understand, do we have the resources monetarily in terms of the amount of money we have to really treat people fairly by hiring enough staff to do the work and paying them an equitable wage? So we've so far really just looked at the basic, again, money coming in and money going out. These next few slides, we're going to take that and separate out those dollars a little bit and complicate that idea a little bit before we look at it in terms of actual dollar figures, of just the way that money flows through an organization. And so this first slide here, we're really going to spend talking about restricted and unrestricted dollars. And so if you can kind of bear with me on the metaphor, the water flowing through this system represents the dollars that are coming in and then ultimately out of the organization. And we use this metaphor of watering our carrots here, or our flowers, that we want to make sure that the water is actually able to be used to cover our expenses, that the are actually able to be used to cover what we need to. Things like our staff salaries, like our rent, like advertising, all the things that nonprofits spend their money on. And so in order to be able to be used for expenses, we need those dollars to sit in this bucket that says without restrictions. So there are a couple ways that we get dollars without restrictions. Earned revenue. So for example, if someone buys a ticket to your show, usually as long as you put on the show, after the show is done, you could use those dollars for whatever you need to use them for. Sometimes we get contributed revenue without restrictions. So these are oftentimes individual donations. Sometimes foundations will give dollars without restrictions. And all those dollars, again, can be used as we see fit once we have them to cover our expenses. On the other hand, oftentimes nonprofits have dollars that come in with some sort of restriction. Those restrictions either can be based on timing. So for example, you may get a grant that says you're able to use half of these dollars in 2021, and you have to save half of them for 2022. Or for a purpose, which means that these dollars can only be used for this very narrow purpose, that we are paying you to do this one specific thing. And so when those types of dollars come in with restrictions, they wind up in this bucket up here. And in order to use them, they need to be released from restrictions, what we call net assets released from restrictions here, coming through this into our idea of without restrictions, our bucket over here. And so the way that those dollars get released from restrictions are either by time. Again, if you're told from the beginning that you're allowed to use those dollars half in 2021 and half in 2022, then half those dollars get released in 2021, and the other half get released in 2022. Or by purpose, from sort of the accounting perspective, they get released when you spend the money. So if, for example, you are given a grant that says you're going to hire a specific staff member to run a specific program, when you spend the money on running that program, that's when they get released, and then it almost immediately go into expenses. So I'm going to pause there just for about 10 seconds and see if there are any other questions or comments in either the question box or the chat. And if not, I will notice I didn't show this while I was talking because it's a little bit more of just a jargony definition. I want this to sort of be kept for a takeaway. But again, note that it's when either you fulfill the purpose or the timing that dollars are allowed to move from the with restrictions into the without restrictions bucket. So this is our first time that we're going to really look at numbers together. Oh, and I'm just seeing here that some questions are coming up. So I'm going to move back up to this here. So first I see from Joseph, how does net assets released reflect in the balance sheet? So that's a really, really good question. When assets are shown on the balance sheet, so when you get your grant, it becomes an asset, usually in cash. Those dollars sit in a kind of separate bucket called net assets with restrictions until they're able to be spent, again, either by time or purpose. And when they're able to be spent by time or purpose, the net assets released is something that happens on the business model side, on the profit and loss statement. When that happens on that side, they get moved into a different category, which is net assets without restrictions. And then they sit in that place until they are used for expenses. And so you'll have these two different buckets. And again, this is something that will be covered a little bit more deeply the next time. But at this point, just know that they'll sort of move from one bucket to the other as you're able to use those funds. And I'm seeing another question from, I believe it's Pilar. Could you explain temporary restricted funds? And so the idea of temporarily restricted funds is that they're funds that, again, are sitting actually on your balance sheet. You've already received those funds, but they have not yet gone through this pipe. They have not yet been released because either the time has not yet come for them to be released, or you have not yet fulfilled the purpose that releases those funds. So again, that's sitting sort of on the balance sheet side, that when the money comes in, it sits in that separate bucket of funds that you're technically not able to touch, either until the time comes that you're allowed to, or until you're able to use it for those purposes. And then I'm seeing another question here. Is there a best practice in terms of where the money is kept, i.e. in a separate banker's account while restricted? And I will also note there that it depends on kind of every organization has their own system. If it is helpful to you to know that it's in a separate place, then it could be helpful. There's some funders that do require organizations to keep those funds in a separate account. But as long as you're able to really track those dollars and know when they're able to be used, they don't necessarily have to be kept in a separate account. So temporarily restricted funds are net assets with restrictions. Is that correct? Yes. So temporarily restricted funds is a term that from an audit perspective has actually changed over time. So funds that were either restricted based on timing or purpose, if the intention was that you could eventually use them, they used to on an audit be called temporary restricted funds. Now they're just called net assets with restrictions. The other sort of way of looking, it's the temporary, and then you could also have permanently restricted funds. And so that's like how we traditionally would think of an endowment. Right now on the audits, they no longer separate either temporary, which is eventually going to be allowed to be used, versus permanently that will never be used. But sometimes you'll still see both of those terms. And to that note, yes, permanently restricted versus temporary restricted is another question that I believe I've already covered now since the person put it in that chat. Okay, so we're looking at the numbers now, and I will say we're not necessarily going to worry so much about the specific numbers that are on here as much as just the different places. And so I know a lot of people don't like to look at numbers. I myself did not start in the finance world and also get overwhelmed looking at numbers sometimes. But I'm just going to point out a couple of things that are on here. So like we talked about before, the revenue, we're talking about different types, different sources of revenue coming in here. We're looking at our expense down here and our surplus and deficit. We're going to split out what is coming in with restrictions versus without restrictions. We have our net assets released from restrictions. That's when we move dollars that were once restricted to being unrestricted. So this organization had about $110,000 come in 2020 with restrictions. Of that, 10,000 of those dollars were released from restrictions, moved into our without restrictions category. So we wind up getting our revenue without restrictions, our revenue with restrictions, and our total that has both together. Oftentimes also we'll just have as a reference point the previous year will also be on that sheet. So a couple different areas. First to say, again, we have multiple lines of surplus or deficit. So we have on a unrestricted basis, on a with restrictions basis, and then a total. We have this line that I pointed out before of when the money is moved from that bucket of with restrictions to that bucket without restrictions. So I'm gonna ask us to all try and weigh in through a quick poll, which should be available in just a second. But from these, and there's the poll, from these three lines, when we're thinking about is our business model working or not, do we think that we want to look at the line without restrictions, with restrictions, or total? Again, without restrictions, with restrictions, or total when we're thinking about is our business model working? And so I'll give it just another 10, 15 seconds for those that aren't sure. Okay, and I'm going to go ahead and end that poll and share results. And so there's a little bit of disagreement among the group. People aren't really sure where to look, which is absolutely okay. That's exactly what we expect a lot of the time because it's confusing. There are three different bottom lines. Why are there three different bottom lines here? And so what I will say is that from our perspective, when we are looking at a income statement, we want to look at this line that says without restrictions when we're looking about if the business model is working. And the reason that we look at this without restrictions line is that we want to make sure we're talking about dollars that we're actually able to use, right? And so this organization is sort of a perfect example of that, where they had a lot of money come in that they weren't actually able to use that year. And so even though they got this $110,000 worth of restricted grants, that makes it look like from a total perspective that they had a surplus for a year, they were not actually able to access these dollars. And therefore, from the dollars that they're able to use in that year, we're actually looking for this organization as a deficit for that year. So I'm going to pause there because I know that this concept is a little bit confusing and just see if there are any questions that come in as a result of this. Okay, and so I'm not seeing any questions yet. Again, the reason though why we're looking in this column is that we want to think about the dollars we're actually able to use during that time. And so I have a question here. This was an assumption. that it's a year-end income statement as opposed to a quarterly income statement. So we know that seasonality can make a difference, like we were talking about before. And so this assumption is that we're looking at the end of the year. That being said, you also can look by quarter and think about, for that quarter, did we have a surplus or deficit for that quarter based on the dollars that we were able to use at that time? It may be that one quarter we have a planned deficit that we know we're not going to have as much revenue as we need. We're able to pull from our balance sheet in order to cover those expenses temporarily until we're able to use more dollars later in the year from that source to subsidize the beginning of the year, if that makes sense. Okay. So one other complication, right? We've talked about restrictions. Now we want to talk about a distinction between what is considered operating versus non-operating. And I'm seeing one more question actually. What about restrictions that are released from prior years? So these dollars in this case, it looks like they probably came in from this year. There may also be a bucket, again, sitting on the balance sheet of dollars that came in 2019 that they probably didn't get to spend that whole $254,000 the year before. And so this net assets released from restrictions at times might actually be higher than the dollars that are coming in new that year. And so these dollars, it's not entirely clear on this example here. They're using dollars either from previous years on here or that came in this year. But they would show up in that same line, the net assets released from restrictions, whether it's coming from prior years or during this year, which is why that maybe you have, a big fundraising year that you get a lot of restricted grants. We want to be able to show when the dollars are actually able to be used in this net assets released from restriction line. So thank you, Tracy, for that question. So coming back to this operating versus non-operating concept, there's two different things we're looking at. Operating is sort of our regular, repeatable revenue and expense, the things that we expect to happen each year, as the way that we do our work, the way that we run our organization. We want to separate, or what we'll call budget below the line, and I'll show you what that means in just a minute, for these what we call non-operating revenue expenses. So these are one-time or occasional things that come in that we're not expecting as sort of a typical normal part of our business model. So we have some examples on here. The big sort of point here, though, is down at the bottom, that non-operating dollars can obscure the picture of true operating performance if we put them together with operating revenue and expense. So a good example there, if we look at just, the different types of revenue and operating revenue and expense we have up here. Something we would consider as a non-operating is a bequest. So if someone leaves your organization money when we die, we don't want to expect that to come in every year. We don't want to make it look like if someone leaves a really significant amount of money that you're going to expect year over year to be able to get that money, because that's likely not something that's going to happen every year. Similarly, on the expense side, if you were to buy a new building, we don't want it to wind up making it look like you had a really, really significant deficit that year when the cost of that building is not normal for you. It's not part of what you're doing year over year. It's unlikely that you're going to buy a new building every year. And so we'll talk in just a second about what that looks like in terms of the numbers, but I am seeing a question here. Can you provide guidance as to when grants should be recorded as income, when awarded, when money is received? We have grants awarded in 1 year, a project that spans several years, and funds received only once benchmarks are reached. So that's a really, really good question. Technically, the way that it'll show up, and a lot of this will wind up actually happening on the balance sheet, is that when it is received, if I'm going to go up to my right here, when it is actually received, we're going to recognize it as a revenue with restrictions here. It's going to also show up on your balance sheet as either a receivable if you haven't gotten the money yet, or as an actual asset if you've already gotten the money. It's also when we're actually able to use it going to show up on the net assets released. Again, some of that might be released in that year. Some of it might actually be released in a future year. And so that's where we're getting those two different amounts is again, what is received or what is awarded as opposed to when the dollars actually come in is when it shows up on our with restrictions here. And then when it's able to be used, it gets released from restrictions down here. Again, they'll get next week when we talk about what is a receivable versus what is an asset versus what is a liability. That'll all come up in our next session. But for now, I'll give sort of the part of the answer that it's when it's awarded that it shows up here as opposed to when the funds are received. So I'm now seeing from Carlos a question around this operating versus non-operating idea. Why are pass-through dollars considered non-operating revenue? And also in kind. So it's actually a similar answer for both pass-through and in kind, that they're dollars that are not generally for most organizations that are not part of your sort of, again, way of operating, way of quote unquote doing business. And so we don't want to wind up inflating the size of our budget to make it seem like we're this really, really huge organization. If in fact the work that we're doing on a day-to-day basis is at a sort of smaller level. And so, you know, if we are, for example, an organization that runs a budget of about, you know, $500,000 a year, but then suddenly we get this huge, huge grant where we're passing through $500,000 or more to other organizations, we don't want to make it seem that the work we're not really doing from a mission-oriented perspective is much bigger than it actually is. So we want to just separate that and put it into sort of a different line. Same thing on the in-kind end. It's not real dollars that are actually coming in and moving out of the organization. It's when people donate their time or donate physical things. And so we want to think about it just in a slightly separate category. We still want to represent it there, but we want to make sure we're showing sort of what are the actual dollars coming in and out and sort of the top of it. And then below it, we'll show what are those in-kind, the different types of revenue and expense. And the Carlos was just saying thanks because it's not always shown. And absolutely, this is something that is not always shown, but it can be a really useful way of telling your story, being a little bit clearer with those people that are looking at your finances as to what is sort of our business model, what is the way that year over year we're able to fund our work versus those sort of one-time out of the ordinary pieces or things that might inflate what we're doing. So what about in-kind expenses you would have if not donated is another question from Tracy. So in-kind is always shown both on the revenue side and on the expense side. And so the idea there is that if you were not going to have that service donated by someone, you would probably have to spend money. And so it's still going to show up in order to be able to show that that could potentially become a real expense at some point. But at the same time, again, we want to separate it just to show that it's not those quote unquote real dollars coming in and out. It's still going to show up so that you could represent that it could potentially become real dollars, but as of right now, it's not. And I hope, Tracy, that answers your question. Okay, so if we look at it actually in terms of the dollars here, I've really simplified all of the revenue. So we just see the total operating revenue at the top and the total operating expense at the top. We still have that line of surplus deficit here. And so we're still going to look here for a regular business model. Is it working or is it not? Coming to that same spot, right? Year over year, do we have the right amount of revenue to cover our expenses? But then below the line, we'll put these sort of one-time or occasional things that we're not expecting to happen every year. So for example, a PPP loan is something that many organizations were able to receive this year, that you don't want to make anyone think that we're expecting that to continue coming. So we're going to put that below the line, that helps to cover some of our deficit for this year. as a way of bringing in additional revenue. Same thing with any sort of COVID response fund that's come out. It's different than what we would typically see. So when we separate it out, we get to see what our sort of normal operating performance is for our normal sources of revenue and expense. And then separately, any money that came in just this year that's different than what we would typically do on non-operating revenue. And same thing on the expense side. Again, if you were to buy a building, for example, you wouldn't want that to show up and make it look like you have a huge deficit from up here. We put that separately. So this one-time equipment purchases, again, thinking of terms of 2020 or 2021, a lot of organizations are right now spending money on things like air filtration systems, ways of keeping the space a little bit cleaner than it has in the past. And so we want to make sure to just separate that out as, again, this is not our typical thing that we'll look to spend money on, but right now it's really important that we do it. And so we're showing it below the line. And so we're seeing our kind of, again, typical operating model up here. And then down here, we'll see the total of what actually happened to our financial position that year. Meaning, did our net assets go up or did our net assets go down as the result of everything that happened that year, both from an operating perspective and from a non-operating perspective? So I'm seeing a question here. Thanks, does this mean that the PP loan was forgiven and therefore recorded as revenue? Yes. So a PPP loan, originally when you have a loan, it shows up on the balance sheet both as a asset, meaning money that you have in the bank typically, and also as a liability, meaning that you owe that money back to the government. Technically, PPP loans are all owed back to the government until they are forgiven. So then once that they are actually forgiven is when they wind up showing on the income statement. This really probably should say PPP loan forgiveness is when it actually is recognized as revenue as the money coming into the organization. So thank you for that question. Okay. I'm going to keep pushing us along, just knowing that we have limited time today, but I really, really appreciate all of the questions and comments. So thinking back to, again, what is our actual model? Once we've separated all, once we've seen the way that the dollars are falling through, we really want to think about where the money is coming. And this is where we talk about connecting our past to the future. We want to understand what is sort of our revenue mix. And so there is a poll which we can go ahead and do, and I'm going to sort of talk through the poll while you're answering it, just based on time here. And so the poll is just, what is our largest revenue stream? Is it earned income, individual, foundations, government, or other? Just to get a sense so we all know sort of who's on the phone, the kinds of partners that we have that are funders. So again, we want to know in our past, where has the money come from? So that we have a sense of, in the future, is it likely to continue to come from the same places, or is it unlikely to be able to continue to come from those same places? And so each of these sort of sources of revenue have different sort of complications that come along with them, different strengths, risks, and costs. So for example, earned income, that's money that again, someone pays you directly for work. That tends to be flexible once you have it, although it can be sort of hard to develop an earned income stream. Individual contributions, again, they tend to be flexible when you get them, but at the same time, it can take a lot of investment in developing an individual contribution stream. Foundations tend to, and also government, tend to be a little bit more specific that the money needs to be spent in a specific way. And it also tends to cost a lot of money to invest in yourselves to be able to meet the requirements of foundations and government. So thinking about that balance, how has it worked in the past? Can you expect to keep that balance in the future? And if you were to go after a different stream of revenue, what kind of investments would you have to make in order to be able to go after that type of revenue? And so I'm going to go ahead and end the poll. And it looks like there's a lot of people on this organization, which is not surprising in the arts world, that have some earned income as a real major source for them, but that they also have these other sources that can sort of subsidize the fact that you're not charging your quote unquote customers, your community, the full cost to run what you're doing. So as I said before, that's pretty typical in the arts world, and good to know as a group. So on the expense side, right, just like we have these different types of revenue, we also typically think about different types of expenses. So for many organizations, the largest sort of bucket there is our personnel. The people that we're paying to do the work, to offer our services to the community. We also have professional fees. So this is if you are required to get an audit, if you get federal dollars, for example, you might need to pay an accountant to do that audit, or you might have a lawyer that you speak to about decisions that you're making. We also have occupancy. So if you're renting a space or you're paying a mortgage, it goes into sort of that occupancy. And then support is just everything else. It's sort of our catch-all term for something that doesn't fit into one of these, major categories. When we're thinking about our expenses, again, we want to use our history, what we've seen in the past, to help us make decisions and tell the story about what we expect to happen in the future. And so we want to know, where are our levers that we can pull? Where are we able to make changes if we need to? And we see that we, for example, need more revenue to cover our current expenses. Are there areas that we can save money, or are there areas that we can invest in order to bring more revenue in the future? And we really always want to think about that interconnection. The way that anytime we have a change in our revenue, there might be associated expenses that rise or fall. Anytime that we change our expenses, it might affect our revenue as well. And we want to think back and forth between the two. And so this is just an example of a way to visualize our revenue and our expense, thinking about just what that mix is, and thinking about the ways in which, as certain types of revenue increase, our expenses also are going to increase as a result of that type of revenue. And so I'm going to leave this up in the background, but I do want to make sure, because we're getting pretty close to the end of our time today. Does anyone have any other questions about anything we've talked about today, in terms of the overall business model, in terms of our revenue, in terms of our expenses? I really do want to prioritize those questions before we maybe take just a minute for this activity related to this. Okay, and so I'm not seeing any questions come in now, but I'll keep my eye on the chat. In the meantime, I want to start kind of wrapping us up here, so that we can make sure we can get out on time. And thinking through, as a result of today, and feel free to put your response right into the chat, either from our head, from our heart, or from our feet, something that you learned as a result of today's session, something that you felt as a result of today's session, or some action that you're hoping today as a result of the content we went over today. So I know it was really quick. I know it was a little bit technical, the way that we were talking about finances today. But again, either something you learned, something you felt, or an action you're hoping to take. If you can go ahead and put that in the chat, I'll read out them as they come in. So I'm seeing Kenneth says he's a little more comfortable with these statements. Thank you, Kenneth. And I'm seeing Carlos had put into the question also, I think nonprofits must consider a forward-thinking financial operations, specifically during the COVID recovery phase 2021. Donors are getting tired of giving for the same purposes. And absolutely, Carlos, I definitely agree that things are changing very, very rapidly. And a lot of people are looking for sort of creative ways to fund creative things and new purposes. And so this is the time that we're seeing a lot of new thinking around the way that funding happens, and what actually gets funding. So I appreciate that. Kenneth also said, I was unclear about restricted funds and understand this better. Any other reactions? Again, something you learned today, something you felt today, or some action you're going to take? I'm seeing from Mara, I believe it is. This was incredibly helpful. I'm going to ask our accountant to reflect released restricted funds in a clearer way. That's what we love to hear, Mara. Again, working with your accountant to not only do it according to the rules, but show things in a way that affects your story so that you can think about how you want to share with others what has happened from a financial perspective, and also so you could understand for yourself and think in the future. I'm really glad to hear that, Mara. I'm seeing Morgan. I really appreciated listing out the hallmarks of an organization with a healthy business model. As a program person, program meeting the needs being a part of the equation was refreshing to see. Absolutely. We're mission-driven organizations, and we want to make sure that it's not just about the numbers, but also about how those numbers reflect the work that we're doing. John said the importance of segregating one-time income expense items, quote, below the line. Again, hopefully it's a helpful storytelling piece to be able to reflect pieces there. Okay. And so while potentially some of those are still coming in, and I'll continue to read them if they do, I do want to just look ahead, look forward about additional resources. Again, we're part of a larger series, but this is just the NFF components of what we're going to be offering over the next few weeks and few months, starting with next week, where we'll be sort of finishing this financial planning with really a more in-depth discussion about the balance sheet. That's going to be led by my colleagues Kaya and Christine, really thinking about how we are understanding, reading like we did today, the balance sheet, and also thinking about how, from a strategic perspective, we can use our balance sheet. So we'll look forward to that. I really, really appreciate everyone engaging. I know it's kind of hard to engage in this platform, but I appreciate all of the questions and the comments. So thank you, thank you, thank you. I'm seeing that there are still some coming in, and so I'll leave that for everyone to read for themselves. But I really, really appreciate being able to spend the time with you today.
Thank you so much, Robert, and thank you for everyone coming today. Sarah, if you haven't registered for part 2 that we are offering next week that Robert's been talking about, Sarah has put the link into the chat. So you want to go ahead and register for that. We don't automatically register for you the second part, so make sure you do that. I also want to say thank you to NFF because you were part of our original folks that we went to last spring when the crisis was evolving. And so we actually have a full series dedicated to emergency planning that you can find on our YouTube channel. And one of the best resources I feel that came out of that, I'm putting in the chat now, is called Ask NFF. So this is where if you do have questions that come up after this and you're like, I just need to ask somebody who might know the answer, this actually was a wonderful resource that you developed to ask the questions to live and get an answer from an NFF advisor. And so what I loved about this is that they also put all of these together, made them anonymous, and put them up on the website. So chances are your questions may already be answered in some way. So if you haven't checked out the Ask NFF link, feel free to do it. And if you do have a question, feel free to ask them and get an answer for it. So thank you, Robert, for giving us your expertise today. We really appreciate it. Thank you all for hanging on to talk an hour about financials. And we will see you at the next webinar next week. Thanks and stay safe. Bye.
And everyone, take care.